Hey, everybody. Hopefully you're having a really nice weekend out there. We had a positive week in the stock market last week, and that was a nice thing. It looked like on Thursday, it was going to get a little sketchy. Thursday, the market sold off and sold off quite aggressively. Now, on Friday, stocks recovered. So overall, it was a winning week. As we look at the stock market, it is great that the NASDAQ over the last year is up almost 33%. I love seeing my stocks go up. Who doesn't? Love seeing that. I just begin to feel like, hey, stocks are getting expensive again. I thought, a couple months ago, if you watch my channel and watch my streams, I kept thinking, man, stocks are getting expensive. Some stocks, especially some sectors, some industries are getting really frothy. And, we had a pretty nice correction, especially on the NASDAQ. We had a 13% correction. That's a pretty nice little haircut to stock prices. And I thought that was healthy. Hey, we took some medicine. We kind of brought down some prices that should have been brought down. But the market, as incredibly as it sounds, it's almost made up that gap of 10%. And it's made it in 14 days. That's kind of nuts. And I'm now again beginning to be uncomfortable, happy, but uncomfortable. I'm happy to see my portfolio go up. I'm happy to see all those gains. Thank you, stock market. Appreciate it. But for me, it's about making money every year. It's about trying to look forward and really make some changes to my portfolio where I can make more money, or I can dodge potentially too much risk. And I wanted to start off the live stream by talking about how I'm seeing the market, where I think the investing is best for me, and how my mentality as I look at the next stock to buy, or which stocks I currently own that I continue to buy shares in, or overall, how am I, pursuing investing for the next, let's say, 6 to 12 months. And the reason for it is, stock prices go up and down, mostly up. And back in 22, we had a very big correction. We had the NASDAQ go down 35%. I don't know that we're going to experience that. Not sure we're going to do that. But just a reminder that stocks will not go up indefinitely. They go up for the most part, but they can get quite corrected. As we hear the Federal Reserve say, hey, we're going to start reducing the interest rates that banks lend to each other. That drives down interest rates, and interest rates have already adjusted. The markets are smart. They see the interest rates coming. So you see bond prices changing. Interest rates are already coming down. If you're applying for a mortgage, as an example, you're already getting a lower rate. Having said that, interest rate reductions communicate that a recession is coming. Now, if we have a recession that causes a lot of job losses, that's going to be significant to the stock market. Reason for it is, as people lose jobs, they don't spend as much money. There's more fear really generally in our economy. That fear really will manifest into people just wanting secure investments, so to speak. And stocks tend to go down. Not sure we're going to see anything like 2022. I would guess that the chances of that repeating in, let's say, 2025 are pretty low, but it could happen. Who knows? If we have a combination of bad recession, a couple other bad stories to add to that fear, then we could see the stock market correct substantially in 2025. It's just good to keep an eye on where stock prices are at. You can't be oblivious to conditions. I certainly try not to be oblivious. I try to understand, where are we in the economy? Where are we in the stock market? Do I think the stock market's expensive or significantly sold off? And I'll tell you a quick story. We had the great meltdown of the 2008 meltdown, right? We had the big reset. I think they called it the Great Recession, because in that time, the NASDAQ, as an example, went down 44%. And there was a lot of gloom and doom in those years. I was invested in stocks and real estate. Not yet had made it to Bitcoin. I wish, but not yet. I started investing in Bitcoin around the 2018 timeframe. And the reason I bring this up is I was aware that the market was severely sold off. There was just so much fear in the market. And I made big investments in that era. I worked harder at work, made some more capital. I ended up buying 5 investment properties, real estate wise. I maxed as much money as I could, putting it into the stock market. And that was a great idea. So being aware of where we are economically, where the market is important in my type of investing, which is making good investments at the right time. Not necessarily trying to time the market. I'm not talking about that. But in this era, as an example, Warren Buffett was quoted, because I ended up buying real estate he was quoted as saying he would be very interested in buying single family homes if he just could figure out how to manage them, but he couldn't. So he was going to stay away from it. And that was just like one more data point that I took in. And I took a significant amount of capital, bought properties. All those properties have been multi-baggers. And it's been a lot of fun. It's been fun to see an investment that when everybody else was scared, I made that investment and was really rewarded with a great return. So being aware of where the market's at is really important. Fast forward to today, we're not in a down market. We're actually in a pretty prosperous market with prices being fairly high. So I'm just aware of that. Do I think the market's going to go up another 33% in the next 12 months? No, I think it could go up. It could be going up if maybe 10, 15% is my best guess. Nobody really knows. And the reason for it is I think we have enough to worry about going forward. That's probably going to cause a couple of corrections here or there. The recession that I noted a little bit earlier, the Federal Reserve reducing rates is both positive and negative news. Fundamentally, it's bad news. They're reducing interest rates because the economy is slowing. That means we have higher job losses. We have those types of things now to worry about, which is a more substantial economic worry. Now, the good news is that with lower interest rates or discount rates on stocks and so forth, that discount rate is lower. So you can actually yield a higher valuation for a stock. But first and foremost, if businesses are not growing, if they don't have prosperous economies to operate in, then I don't care if you can have a better discount rate. It's better to have a very strong business. So that's two ways to interpret what they're going to do with interest rates. We'll see how many of the cuts they make. And again, how the bad news continues to roll in. I know I've seen a lot of corporations come out and make an announcement that they're going to be laying people off. And these are, big numbers, 15,000 here and 10,000 there. And these are well-paid, usually, white collar jobs. And the more and more that happens, I think a good part of that, employment pool begins to suffer. So let's see how that rolls out. The other things that could, sting, the stock market is there are a couple of trends out there that are have a lot of energy. The biggest one being the AI trend, right? And if you watch my channel, look at videos, where I stand is that AI is really interesting. It's really interesting to talk about. My experiences in life and in career and professionally, and really through investing, I'm pretty knowledgeable on technology, pretty knowledgeable on what AI is. I'm not an expert, but I know what it is. Now, when I look at AI and see that that's probably the biggest catalyst that is driven the technology pricing, especially in semiconductor, I think AI is interesting, but I don't see a lot of businesses that are making really revenue to begin with, but are making any money. NVIDIA most certainly is making money, but they're selling the infrastructure for companies to use AI to then build businesses. So it's not, to me, it's not a supported economy just yet. Maybe in the future it will be. And I think that story, if that story begins to fade, or maybe if that AI hype bubble will burst, that could also cause a pretty good correction, especially in semiconductor and technology. I'm really watching that closely. You guys watch my channel. I am shorting NVIDIA, Broadcom, Vistra. I'm shorting a number of companies that I think are linked to the AI trend. And if that trend turns out to be a couple of things, I don't think the trend's wrong. I just think it's going to take a long time. I'll give you an example in Waymo. Waymo is the robotaxi self-driving technology. It's pretty awesome that Alphabet owns Google, and they own it. They have self-driving cars that pick passengers up in Phoenix, San Francisco, and Los Angeles. It's taken them 15 years to get to where they're at. They've spent over $20 billion or so on that particular line of business. Their revenues are just a couple hundred, less than 100 million so far on Waymo. So it's really just been a research and development project for Alphabet. And they have plenty of money and they want to make big bets. And this is one of them. So my point being with the AI hype is, I think in a lot of ways, it's probably going to be real. It's just going to take a long time. And the return on investment, profitability, free cash flows, we're like 5, 10, 15 years from that perfect time where these companies really are making lots of money. Between now and then, how much will they invest? These, leaders of these corporations, they're putting their careers on the line if they were to put a couple $1 billion into AI, and it doesn't work, especially in the near term. Now, I get that the hyperscalers are buying a lot of GPUs, like AWS is an example, but they're buying those GPUs because they basically rent out that capacity. That's a little different. It's not like Amazon's creating, AI businesses out of it. No, they're hosting other companies that want to develop AI businesses. So that's going to be really interesting to track, and we'll see how that plays out over the next 12 months, because I think it's going to begin to wane on investors. I already hear, investors really begin to question, as they should, hey, when will we see, the terms that I hear is that killer AI app? And when will we see businesses really start to become real around AI? It'll be interesting to track. So I'm tracking that quite closely. I think that is going to be a bigger factor on where the stock market trades versus the economy. Those two are the biggies that I'm looking at. Other than those two, just the regular stuff, I'm sure there's some surprises that are going to hurt us, or hurt stock prices coming up in the next 12 months. And there's probably going to be a couple of surprises to the upside. Like, hey, we got a tailwind because of something that I certainly have not seen, but we'll see how that plays out. Now, so the stock market's doing great. Now let's talk about sectors. And again, my point of view is that the stock market is priced quite expensively. And I don't know that a lot of people would argue with me. I think some people could say, well, if you look at PEs and if you look at these data, then it's not like super expensive. But I don't know that anybody would argue that, no, prices are a little high. I mean, you look at individual stocks and you're like, man, I love my Meta stock. It's my number one position. I own more than $200,000 in Meta stock. And I'm here to tell you the stock looks a little expensive. I'm not selling any of it, but it's looking a little expensive. It's up more than 400% in the last 2 years. That's a little expensive. Same thing with, I can go down the list of other stocks. So as I look at sectors, especially, and as I interact with other investors on my channel, I oftentimes, hear the conversation piece of where is it good to invest? And I would say with higher prices, it is a little harder to find, clearly discounted companies that are worth a lot more. It gets a little harder, but they're out there. So you just got to do a little more homework, be more patient, and don't just chase stocks. Don't chase investments just because, it's been working for the last couple of years. It's probably going to keep working. Sometimes that recipe works, but I would say that many times that recipe really sets up an investor to lose money. And here's an example: is within technology semiconductor. I owned Broadcom, and thank you very much, stock market. The stock really rallied. I sold all my Broadcom stock. I know that business quite well. I've owned it for a couple of years, and really have known Broadcom for the last 20 years. And having said that, just the fundamentals do not support the stock price. So I got out of that position. I'm not eager to get into semiconductor right now. I think the prices are really high. Stocks like NVIDIA are priced to perfection and then some. I think as NVIDIA starts having more difficult compares, and I'll show you, it's going to get harder for the enthusiasm to continue. When we look at NVIDIA's stock, it's been just an awesome stock for anybody who owns it. And when we look at a quarterly announcement, they grew in the latest quarter, which closed April 28th, they grew by 262%. That's because you're comparing, in that quarter, they had $26 billion of revenue. And you're comparing it to the year prior, they had $7 billion. So yes, going from 7 billion to 26 is a 262% increase. So applause to NVIDIA, incredible. But success and the law of big numbers. As you see sequentially, the next quarter, their revenue is 13.5 billion, roughly a year ago. So when they announce on the 28th next week, will they announce and come in at around 26 billion or 28 billion, somewhere around there, right? More likely. Their compare will be quite different. Instead of it being 262% of growth, it'll only be 100. And I use that word carefully, only 100. But right now, the stock is priced like it's just going to go insane and keep growing at these levels. And let's fast forward. The demand on GPUs is beginning to flatten. I was on a earnings call for a hyperscaler, and they talked about the lead times on NVIDIA GPUs, the H100s. That's the most popular one right now before the new generation. Is the lead times are very reasonable. I think they were quoting that they can get those GPUs in 4 to 6 weeks, when previously it was like a long lead time, like 6 months, because they were just in such high demand. But I think the demand is beginning to come down. So as we look at, especially 6 months from now, when they have earnings calls and they're comparing against these numbers, you're going to see growth that's going to be 40, 50%. And then investors will have to ask themselves, wow, NVIDIA stock is priced as if they're just going to keep going up and up and up. But now we're beginning to see the business slow down, at least in a percentage growth rate. And these businesses, semiconductor, they are cyclical. I don't have to go back too far, just a couple years, and show you where cyclicality hit NVIDIA. Their stock was down 66%. So those are trends that I'm really watching because I think they're going to be really interesting to track. And I think there's an opportunity to both avoid risk and make money. Making money, betting on the downside. We'll see if I'm wrong or if I'm right. And we'll see how soon I'm either wrong or right. I'm expecting that it's going to probably take a year for this to really sort itself out. But in all cases, when you look at stocks that have gone parabolic, they always end in a very, very cruel way to stockholders. These stocks tend to come down, and they come down hard, and they become really a lesson to the whole market. Cisco is in a similar place where they were building the internet. They were the #1 player. They had a real business. They kept growing their business year after year. They kept growing profits, but the stock had gotten so high, the market didn't care. It sold it off severely to the point where it sold it off by 85%. And ever since Cisco went parabolic, the market, the company has not been able to achieve that stock price. So if you're an unfortunate one that bought Cisco way up here, man, that is a cruel punishment that the market paid some of those investors. So that's what I'm really tracking. Super interesting, factors in play there. And I've been investing in stocks for a long time, and I love it. I think it's really interesting to track economy, stocks, these trends, these technology trends, and see how AI is truly going to transform industries and the way we work and the way we think and so forth. But I'm also interested, this to me is like such a great drama playing out live, for the consumers of this information to take in. And I think something similar is going to happen with AI. Keep in mind, this is the internet. The internet drove this stock way high. The internet was real. It really did happen. It really just took a little longer than expected. And investors just got way too greedy. They got way too enthusiastic about Cisco in this case. And they drove up that stock price. And Cisco here, they continued to grow, but they just couldn't grow at the rates that they were growing as they built out the internet, which was like hundreds of percents. Once they got bigger and they had the law of big numbers take effect and they had harder compares, like I was showing on NVIDIA, investors woke up to the news that, oh, they're only going to grow at 40%, which is a phenomenal growth rate. But they're bigger. It's just harder to grow, at 100% forever. You would end up replacing everybody in the economy, and you'd be the only company on the stock market, literally. And that's just not going to happen. As you get bigger, it gets harder to grow. So we'll see how that plays out. That's one of the stories I'm really tracking. But back to the point I wanted to make is I'm not going to chase companies and try to chase, a good performing stock I'm not going to chase stocks that have performed really well for the last 2 years thinking that, oh, they're just going to keep going up. Maybe they will keep going up. I keep buying into Uber. That's going to keep growing up because I look at fundamentals and I look at Uber, and that's the right investment, So I average my acquisition cost into stocks, a dollar cost average, and I've been buying into Uber. Glad to do so. But it always starts with looking at the company, understanding their business, really buying into their business, and then doing the fundamental analysis, valuing a company and making sure that I believe in that valuation. In the case of Uber, I believe in it. And I did my fundamental analysis and continue to invest. Other stocks like Broadcom, I was doing my fundamental analysis and realized the stock's way overpriced. As a stock investor, I sold all my shares, took a big gain. That's great. I expect that stock's going to come down in price at some point. Can't tell you when. And I may be wrong. For all I know, the market teaches me a lesson that my analysis was wrong. But I've been doing the analysis and I have to trust my analysis, and we'll see how it works out. So that was a point that I wanted to make is in a really expensive market, I got to be careful where to invest next. Now, as we look at a recession coming up, I continue to think that healthcare is going to be a pretty good place to invest. I'm buying into companies like United Therapeutics, Pfizer, CVS, Elevance, and Catalyst Pharmaceutical. Those are my healthcare stocks that I continue to buy shares in because I think that healthcare has kind of been left behind this big technology rise. So I think there's a lot of room for these stocks to run. Their fundamentals are excellent. So I like these companies fundamentally. You want a deeper dive on any of those, take a look at my channel and you'll see a deep dive on all the companies I just listed within healthcare. If we get hit with a recession, these healthcare stocks do really well during recessions. It's not like recession hits and you're like, oh, I got to go to the doctor. I got this illness. Oh, but we're in a recession. I don't want to spend the money. That's usually not the train of thought you're going to follow. You're probably going to be like, hey, I have this illness. I got to go to the doctor because I just got to get well. And you go there, see a doctor, pay whatever needs to be paid, buy your prescriptions, take the prescriptions, do whatever therapy or whatever treatment needs to be done, and you take care of yourself. That has been proven, and we should expect to see that, especially around people that are retired. They're retired, and really their longevity and their health is probably the most important thing to them. And we have a pretty significant population that's above 60 years old. So healthcare is going to be one of the plays that I've got going forward. Feel very comfortable continuing to buy shares, and it's been doing quite well for the last month or so. It's up 5.52%, which isn't bad. If you look at technology, it took a haircut, so it's pretty much to even. But healthcare has done okay. If you look at the month performance, and then year to date, it's doing okay, 21%. That's doing fine. It's been historically a good performer, so I think that's going to be my go-to sector where I continue to buy shares. I bought shares this past week. We had some, periods, through the week where some of these stocks that I listed out were discounted, so I was happy to buy into those stocks. The other place is financials. I think you need to pick the right industries within financials. Not all financial industries are going to do great during a recession, but I think some will. Some of them will do quite well. So I'll look there. Other than that, that's clearly like the place to go for lower risk and look for performance is going to be healthcare for me. And would be curious to see if any of the viewers have, what is the right industry that you're looking at or the right sector? Should a recession hit, where are you going to avoid risk and try to grow your capital in that particular investment? All right, so we talked about where we are with the economy. Let me check out some comments here. It looks like we've got 13 viewers. Appreciate you joining. Thank you very much. If you can, I'm taking any requests. If you want to take a look at a stock, feel free to give me a stock symbol. We'll take a look at it. I'll analyze it. I'll analyze the company based on free cash flows, earnings per share, and I'll share with you what I think of that company. All my comments, it's not financial advice. It's just one investor's, opinion on a company. And I don't recommend you buy, hold, or sell any of the companies that I cover. Everybody, thanks for joining. And while I got a quick little break, it's great to be on Stonks. I was watching a live stream before I started mine. Really appreciate other streamers on Stonks, and the people who are streaming, they're more of technical investors, technical traders, and that's a different way of investing than I do. And I really enjoy and appreciate how they view stocks, and really found their session to be very interesting. And what I do is I look at stocks, and I'm really looking at a company. I'm looking at a business, and I really want to know, is that business really desirable? Is it the type of business that I want to invest in? To do so, I really look at, and I'm going to open up a visual that's going to help me communicate how I look at companies. One second. Apologize for the pause. I just want to open up the right file. I'll be right with you. Okay. So as I look at investing long-term, it really starts with really looking for businesses that resemble the most valuable companies on the stock market. For example, Microsoft is a more than $3 trillion value company. And if I could find a younger business, a business that's smaller, that will eventually become the next Microsoft, or any fraction of Microsoft, would be incredible. And the reasons why I would like a Microsoft is that Microsoft has established itself, and it has very strong barriers of entry for its competitors. They're very dominant in the PC space, where Their software is run probably more on more PCs than any other software company, from an operating system perspective, as well as tools that you run on your client machine. They also have a tremendous hyperscaler business and their Azure business. So those two pieces make it really valuable because they have these barriers, the name recognition, make it very hard for any competitor to come in and say, hey, we want to compete against Microsoft on client-based software packages or the operating system. Makes it very hard. I think like Microsoft Excel is very installed in, a lot of the people that use Microsoft, they're so comfortable with it that it's very hard to replace them. So that's the kind of company I'm looking for. Microsoft's been able to grow their profitability, their free cash flows, and in turn, that grows their market cap. They become one of the most valuable companies. I think at one point they did become the most valuable company, exceeding Apple, but now Apple's back on top. And when I look at a business, I want to know, is it a business that resembles a very strong business that would belong in this green quadrant or this green square among this quadrant of types of companies? The businesses I try to stay away from are businesses that have too much competition. Their industry, their addressable market continues to contract. It just becomes really hard for these businesses to make money in the form of profits, free cash flows. And those are businesses, a couple of industries that I put out there is retail. It gets harder and harder to be a retailer. You got Amazon that's taking, buying online. You have businesses in your community that are just constantly competing against you. Let's say you're a retailer for apparel. That's so competitive. So those are businesses that I'd rather not own. I just don't want to own them. I don't care if they're discounted. I don't care if, Macy's was valued at this amount, 20 years ago, and now they're a third of that value. Well, there's probably a good reason for that. They're in an industry that's not very desirable. Then there's businesses that are not quite in the green. They're not in the red. They're more in the gray. These are businesses that I am willing to invest in, but I do have to get a significant discount. I have to, be comfortable that, hey, I'm getting that business at a very favorable price. And I see that the economy is probably going to be good for them in their industry for the next couple of years. So those are businesses I'm willing to invest in. So it always starts with, is it a business that I like? Is it a business that is desirable based on that type of assessment? And from there, the fundamentals have to be there. It's not enough that, for example, Apple, I think, is priced too high. Apple most definitely is in the green. But when I run my fundamental analysis, they're priced too high. So I'm not going to buy Apple stock. Google, on the other hand, they're most definitely in the green. And in my opinion, they're discounted. So I will buy Google stock. So I go through that type of assessment. Once I make that kind of high level decision that is a desirable business, I go into a analysis based on valuing of free cash flows and earnings per share. And I've read books and I've studied investors, especially on YouTube, and I created my own model. And the model is really based on taking a free cash flow forecast for a company, trying to forecast where I think cash flows are going to come in. We're looking at Microsoft and seeing where, in my case, I like to look at the next 4 years and then put everything else into terminal value, which is all the cash flows beyond year 4. These are all very well-known calculations in finance, and you can Google each term and you would understand what they are mathematically, go through the rigor of doing so. I take those free cash flows and I discount them by a discount rate that I think applies for this company. In the case of Amazon being a very strong business with a great balance sheet, 7.5%. I grow the cash flows in the first 4 years by a rate. In Amazon's case, it's 10%, then long-term, 5%. Amazon's a tremendously valuable business. When I discount all these cash flows in the future to today's value, I get $2.26 trillion of value. I add cash because cash on the balance sheet's a plus, but I take away debt because debt is a minus. I get to what I think an equity value is for that company. $2.3 trillion is what I believe that company is worth based on free cash flows. And I look at the market cap of the company that they're trading at. In this case, this is a little dated. It's at the beginning of August. They were priced at $1.75 trillion of market cap. I think they've risen since then. And I compare, value per share that I calculated versus their current price. And I get to a determined discount or premium. In this case here, they're discounted by 30% if I look at their cash flows. So I go through this type of analysis on free cash flows. And I also look at earnings per share. And this is earnings per share that is agreed upon by multiple analysts. They are expected to do $4.66 per share. and I apply PE that I think applies to Amazon, growth business, leader, expanding addressable market, just a lot of factors that make me believe the 36 PE is applicable. Growth rate that I believe they're going to grow their earnings by, and I get a value per share using earnings per share compared to the current stock price. So I, again, get a discount on Amazon. Two different forms of looking at a company. I blend the two, and I think free cash flows is the most desirable method, or the most trusted method. This is the method that Charlie Munger used. This is the method that Warren Buffett, other investors used. So I blend the two, but I take more weight into the free cash flow method. And I, at that point, decided, hey, Amazon is discounted by 25%. So I've been buying into Amazon. The price has been going up. I continue to buy into Amazon. I'm glad I've done so. So my analysis is, I'm a long-term investor, but I'm active. I don't sit on stocks forever. I don't buy and hold forever mentality. I think that's, it's proven to be a saying and not necessarily the right thing to follow. The greatest investor, especially value investor of all time, is Warren Buffett. He just sold his Paramount stake. If it was true that he would buy and hold forever, he wouldn't have sold Paramount. He would have waited it out. But he realized that, hey, that company just is different than what I have. So he ended up selling it and saying, hey, he was wrong in his thesis, and he exited the position. So that proves that, hey, buy and hold forever is just a fallacy. It's something that could be considered as a rule of thumb, but you got to be more active. You got to look at your businesses that you own every quarter, reassess. Are they still the same business? Are they better? Are they worse? Are their industries contracting or expanding? Is their position in the industry getting better or worse? Has something changed in their industry to make them weaker or stronger? So all those things, come into play as I look at a stock and hold it for a long time. All right. So I don't have any requests out there. Not sure if my chat's working. Anybody who's on, it looks like I've got 14 viewers. If you could just say hello, I'd appreciate it, just to make sure this chat's working. So one stock that I'll look at while I wait for any comments out there, that was a surprise, was Workday. So Workday was up at the end of trading yesterday. It was up 12.49%. But this is a stock that I was on the Stonks live stream where everybody made their prediction, and the stock actually went down and then it came back up, which was interesting. So if we look at the 5-day, the company after hours, and I don't think that that's going to give us what I hope to see, but because it didn't look at the after hours, but in after hours trading, the stock was down 5%, maybe 7% after they announced their earnings. And it looked like, well, they're going to open up lower. And then boom, they went up substantially. And it's pretty impressive that, the Workday earnings looked good. They looked like they grew their revenue. And hey, I appreciate the comments out there. Thanks for joining. So as we look at Workday, I thought their earnings were good. If you look at the revenue growth was good, and I think I can see it here. So let me just go straight here. So if you look at the earnings as of the end of July, the revenue grew nicely. And I always treat revenue growth as this is a very good factor of a business. If revenue is growing, customers like the product, more customers are coming on and buying the product. The product is good. If the product was bad, customers would stop buying it. Instead, here they have more customers buying it, or customers that are current customers are buying more of it. So that's a good barometer of the health of the business. It's growing. So that's good. That's why I was surprised that the stock was down so much when they announced earnings. Their free cash flow is okay. It's not going to set any records. The free cash flow for the quarter was $516 million. Let's look at the annual, especially the trailing 12 months. And I showed you my valuation model. And by the way, I provide that valuation model on my YouTube community page. You can download it and use it if you think it's useful to you. Just go to the community page on my YouTube channel. You can download it there. Hopefully someday I'll be able to provide it straight from Stonks, and you can download it from Stonks. But we'll see when we get there. Free cash flow. So the trailing 12 months, $2.1 billion of free cash flow. Very good. They're profitable. They provide free cash flow. Just their valuation, they're at $69 billion in market cap. And probably the best that I could do based on that free cash flow number is I could probably get to maybe 50 billion, 60 billion in valuation if I went through my analysis just because I kind of know the numbers. I probably know what I'm going to grow Workday's free cash flows at. So this is a good investment for an investor that believes in Workday, that believes that they're going to keep expanding. Workday is a company that is a software company, and their probably greatest strength is within the HR area. They provide a suite of applications to do HR, HCM, payroll, everything to do with your employees at a company. They also have other products. They have financial applications. They have analytical applications and so forth. But I would say where they're most respected is within that HCM suite. That's where they're really strong. So if an investor believes in that space, great. You know, this is probably a good investment. If we look at their 5-year, it's been an up and down situation, you know, and overall it's up, right? 36% over 5 years, but it hasn't been incredible. It's been an okay ride, but not an incredible ride. We look at like from coming out of 2022, where everybody took a nice haircut, they're up 96%. Hey, that's pretty damn good compared to, you know, where they were 2 years ago. So in that respect, if you bought Workday back in 22, you're sitting on nice gains, and they have been going up. Now, for some reason, I guess beginning in February, they had a pretty good pullback. They pulled back, you know, 29% or so, 30%. And now they've seen a rally. So it was a good opportunity to buy Workday. Anybody who bought it, obviously, on Thursday is very happy today because they're up 13% or so. So Workday was kind of a surprise stock out there. So we'll see how they behave going forward. The other couple of stocks that performed quite well last week that I recall were, let's see here. I think Zoom. I'm a Zoom stockholder, but Zoom did quite well for the week. I think they had a very good Thursday of trading, and that was with the market tanking. Zoom had a very good day on Thursday. This is with the stock market going way down. They were way up 12.5%, which said something. If the stock market was like, hey, we're selling off all companies except for Zoom, we're going to go up 12%. That was quite impressive. And then from there, the stock went up another 3.4% on Friday. So it's been a long time coming with Zoom. I don't know how you guys feel about this stock, but for a while, look at the year to date. Year to date, you're up 1.4%. But from the beginning to the trough, to the very bottom, and I don't think I grabbed that, so let me try it again. So from the beginning of the year until right before the stock really rallied, it was down 20%. And then all of a sudden, from the very bottom to the top of the rally, it's up close to 27%. So it's been kind of a long-term time planning coming on this stock. And it was good to see Zoom really, you know, fly off the charts. Zoom just drives. We just saw that. Let me give you a comparison really quick. This is a $21 billion company. We just saw Workday, right? Another software company. And Workday is a $69 billion company. All right. Now we saw that Workday free cash flows are $2 billion. Wonderful. Let's take a look at Zoom. Their cash flows are $1.7 billion. Not too far from where Workday is, just below it by 400 million. Yet their valuations are quite different. Even after that big rise of 27%, they're just a $21 billion company, market cap. Yet our friends over at Workday are a $69 billion market cap, more than triple the market cap, but the cash flow is only, doing some rough math, about 20% higher. So I think Zoom is really unappreciated, discounted, and I've been a buyer into Zoom. So you bought Zoom puts, Oliver? No bueno. Yeah, they went in another direction, right? So it's going to, those puts are probably not looking great. But I can understand why you would buy puts into Zoom. If you look at where the stock's been, it's been a brutal ride for investors. Look at that. They were sold off big. They were sold off by like 90%. And more recently, if you look at the yearly, it goes up and down, up and down. But if you were to take a ruler from like this point down, you're down like 25%. So I can understand the idea to buy puts on Zoom. I've been a little frustrated as a stockholder because I've been buying, and I buy at these low points. But overall, my return on investment on Zoom is not anything great. It's just been okay. And meanwhile, my meta stocks flying off the charts, Uber's flying off the charts, Robinhood's flying off the charts, and Zoom's been kind of a sick puppy, just sitting in the portfolio, just barely. Now it's in the positive, but if you look at the time value of money, Zoom has not performed very well. Maybe they're going up from this point. Hopefully they are. I own maybe, how much Zoom do I own? So Zoom. So I own $36,800 of Zoom, and I'm up 4%. Yay. I'm up 4% after 2 years. That's not good. I'm glad that they're going up. But again, been a little bit frustrated out there with our friends at Zoom. Hopefully they get their act together, or they keep their act together, because they had a very good week. So Zoom was a surprise. One little company that, I just heard of them a week ago, and I heard it on one of the live streams, was BTBT. They had a good week. BTBT is historically, they've been a Bitcoin miner, and Bitcoin mining requires, expertise in using GPUs, graphical processing units from NVDA, using them to mine Bitcoin. And these guys have been mining Bitcoin for years. And when Bitcoin was really hot, their stock was really hot, but the market pretty much left them for dead. But more recently, these guys diversified their business and said, hey, a lot of businesses are interested in building large language models for AI. So let's take our knowledge in operating GPUs and use that knowledge and be a hyperscaler providing GPU capacity for companies. And they've signed some really good companies to be customers, and their revenue is just really booming. So that really caused a nice rally in the stock. It's up nicely. If you look at the low point to the high point, these guys are up 111% in less than 2 months, actually in about 3 months. So that's pretty good return over 3 months. And more, if we narrow down to after their earnings are up like 40%. So the whole business model for Bit Digital, it makes sense to me. I'm a Bitcoin investor. I've been investing in Bitcoin since 2018, and really since 2015. I've got a son that's 20 years old now, but in 2015 he was 11 years old, 12 years old, and I support my kids, right? He wanted to be an investor in Bitcoin at that age, and I'm like, hey, what the hell? Let's throw a few bucks in there, and that ended up being an awesome investment. Buying Bitcoin at like $100 was pretty good. Now a coin sells for above 60,000. So we got into Bitcoin. It was more his idea, and that's what got me into Bitcoin. So I got very familiar with it. My son ended up mining Bitcoin in his room. I bought him a couple of GPUs, and he mined Bitcoin in his room. I paid for the power, and he learned something, and I learned something too. So I know that whole GPU market. I understand what Bitcoin is. I started buying Bitcoin more seriously in 2018, and I'm glad I did so. And understanding that the AI business, I also understand large language models, how GPU infrastructure and high performance computing really supports that industry. So that totally made sense to me. So again, I want to be bought in on the big picture. Okay, I bought in on the big picture. Now let's look at their financials. Well, in the quarter, they're growing their revenue 220% with this new high performance computing business being the factor that's really raised their revenue. That's awesome. And I think the addressable market within, GPU capacity is quite large. These guys are tiny. They can take market share from the big hyperscalers, AWS, Microsoft Azure, Google Cloud, and those guys won't even notice. I mean, they'll have to get quite big before those big guys notice. So these guys can keep growing, and they have a diversified business. They're not just a hyperscaler for GPU, high performance computing, but they're also a Bitcoin miner, and they're also in the Ethereum network, and they stake their coins there. So I'm beginning to like this business that, it is a riskier business. It's not like owning a company that's a new known technology. These are two technologies that are cutting edge, but, cryptocurrencies and then AI. But this company came up in a live stream, and the more I dug into this, I'm like, man, this is worth betting a few bucks. And I bought shares before their earnings, and it was a really good idea. I continue to buy shares in this company. I'm going to be buying on pullbacks because this growth rate is phenomenal. And if you look at their profitability and you look at how much cash flow they already generate free cash flow. So I am a believer in this little company, and will be buying. I'm not going to buy like tons of stock in this company because they are little, and little means riskier to me. But it is, if anything, it's fun to invest in a small business. I think they're still 13% discounted. They don't value based on cash flows, but that's normal to a small, young business. Cash flows usually start coming in once you become bigger and you have greater scale. But their earnings per share is off the charts. They're really making really good money. They're profitable. And the way that they operate, they have no debt. So they have very good balance sheet based on, the fact that they have zero debt. I'm discounting them by 12%. I'm driving a higher rate of return because I'm taking a higher risk on this stock. So overall, I'm happy. So that was a neat little company that came up this week. All right. So a couple people out there, thanks for putting a few comments in the chat. Any company you guys want me to look at? So far, no request. That's fine. What do I think about NVIDIA? NVIDIA. Oh man, I think a lot of things about NVIDIA. Where do I start? So I owned NVIDIA stock a couple years ago. Didn't own them when they decided to break the internet. So I'm going to give you the full tour of NVIDIA. And let me give you the ending so that you understand my point of view. Or actually, I'll wait on the ending. So overall, NVIDIA is a big beneficiary, obviously, of high performance computing being a necessity for building large language models, building the AI infrastructure. So in general, you know, they were at the right place at the right time. And NVIDIA, you know, their history obviously was in gaming. That's they came out with their technology to help gamers process the graphics that were on their screens at a real time kind of performance. So that is a really good match with the high performance computing requirements of AI. I think it's awesome that they grew their business and they were at the right place at the right time. I just find it very hard to believe that they can sustain the revenues. I think I went over it earlier and I showed how it's one thing that they're growing 200%, but the law of big numbers, see, this is a big number. As we look at the quarterly, their compare is going to be much harder going forward. The compare on the next quarter that announces this coming week is going to be against a $13.5 billion number, not a $7 billion number. So they're probably going to come in at around 100% growth. And then they're going to guide and they're going to say, hey, our growth is going to be comparing to an $18 billion number. And they may guide and say, we're going to grow at 40%, 50%. And I think that's what might freak out the market and it might cause a sell-off in NVIDIA. The way the NVIDIA stock has played out, it's not a giant surprise that people are excited about this stock, and especially over the last month. You see this growth, right? In the last month, it's up less than a month. The last 16 days, it's up 30%. And I think a lot of it's just people believe NVIDIA is going to be the #1 high-performance computing company, and the gains are going to be limitless. Now, I don't disagree that this is the best high-performance computing company on the planet. It might stay there for the next 5 years. But there's a limit to what you can expect this market's going to have. Do you think Meta is going to keep buying GPUs just because it's cool? No, they probably bought most of the GPUs they need to build their AI models. Google's been buying GPUs for a long time. Apple announced they built their AI models, and they're going to do it on Google technologies, not the NVIDIA technology. So I don't disagree that Google is an awesome company and the company that's really benefited from the situation. But what I find it hard to believe is that they're going to sustain this valuation. Their valuation is a $3 trillion company, $3 trillion. That's amazing that they're valued that high. I believe semiconductors are cyclical. You have a build out of infrastructure and then everybody has what they need and you have a decline of demand. At some point, we're probably going to see a decline in demand in NVIDIA. And I think, again, the outcome to investors long-term, they're going to get punished. They're going to get hammered. Now, is that going to take a year, 10 years? I don't know. We'll see. That's my thesis. I could be wrong. We'll see. But I'm willing to put my capital where my mouth is. I've shorted NVIDIA. I've got about $9,000 at risk, and I'm probably going to keep it out there through the earnings and see where it goes. I'm down 11% on that short position. I've averaged in my shorted price, and there hasn't been anything that's made me change that expectation that I think NVIDIA at some point is going to fall off a cliff and end up similar fate as to, I should say, the company that resembles this. And again, I'm 56, right? So when the internet hit, if you're 26, this AI thing is kind of like my experience with the internet. I was already through college, 30 years ago, and I was early on the internet. I was on bulletin boards way back when. I was, did my college education on a computer, all that stuff. But the internet wasn't connected like it was, and it started to be connected and started growing like crazy. And Cisco was the real deal, man. They had the best technology to connect the internet. They were growing their business just at a high rate. But what happened was the stock just got too high. Investors were like, oh man, Cisco is going to be worth so much money. They wouldn't quantify what that would be worth. They just bet that they were going to just own the space, and the space was going to be limitless in value. And the stock price got way too high. And when they started seeing these compares on Cisco, when the numbers kept getting bigger And instead of them growing 300%, you know, if you compare that quarter versus the same quarter previous year, and they only started growing at like 80%, the market freaked out and they sold off the stock. And we'll see if that happens. I will be a student of the game. If NVIDIA defies gravity and keeps going up, I'm going to exit my short position once I've lost 30%, or I will sell my short position once I've made 30%. We'll see which one happens first. Recently, I think I made 52% shorting Supermicro. Supermicro Computer this is a hardware company. Hardware companies tend to be low margins, low cash flow. And these guys, their stock just took off. I shorted them. And recently I sold the stock, made 52%, made it in about a month's work. And thank you very much, stock market. The other stock, and this one was more luck than skill, I shorted CrowdStrike. And I shorted them. And 10 days later, I walked away with like a 42% gain. So am I going to be right on these shorts every time? No. Am I going to lose money? Yeah. Every once in a while, I'm going to lose money. But I got to exercise like some of these things that I'm seeing where I see these stocks, you know, just go crazy, like CrowdStrike, which is a security software company. Yay, wonderful. Up 311%. Now, why were they up so freaking much is what I asked myself. They're a security company. If Microsoft got serious about security, they could eliminate CrowdStrike. And Microsoft is getting more serious about their security. They're not going to depend on third parties like CrowdStrike to do it because CrowdStrike caused the biggest outage in the history of computing. So this is one of the shorts that really worked for me. If you want to see my videos on CrowdStrike and Supermicro and NVIDIA, go to my YouTube channel. Full analysis gives you more details on my short position. And again, I commit to making videos and coming on these live streams and talking about NVIDIA, win or lose. If the market kicks my behind, I'm going to keep this rated PG. I will come here and I will take my lumps. I'll even get on with another live streamer and take my lesson. It'll be humble pie, but we'll see where it ends up. If it ends up working that NVIDIA does crash and burn, not crash and burn, I would just say, if it really comes back down to earth, because I think NVIDIA, when I do the valuation on NVIDIA, and again, I don't just go into these things going, oh, I don't like NVIDIA, so I'm just going to short it because I don't like them. You know, that's stupid to think that way. I give them the best, most favorable forecast on their free cash flows. I give them high growth rate on their free cash flows. This is a cyclical industry. And even having said that, I still give them a projection of being a non-cyclical business. But cyclical businesses go up and down, okay? They're a part of a cyclical business. I don't know that a lot of people would argue with that, hey, semiconductors are cyclical. That's proven. And even with that, I think NVIDIA's priced at a premium, even with the best forecast that I can put out there for NVIDIA. And I would love to see if somebody out there that, you know, is an investor bull can kind of go through their numbers and kind of say, hey, this is where I think I think the company, my forecast says they're going to rival Apple and Microsoft in their free cash flow generation, even though their revenues are a fraction of what Microsoft and Apple do. Having said that, I'm still going to project that just to make sure that, you know, I'm not setting myself to run a fool's errand in shorting NVIDIA. So you asked what I thought about NVIDIA, and I'll give you that answer. And that's Oliver. So I'm going to be accountable to you, Oliver, because I know you guys have been tracking NVIDIA. It's going to be the Super Bowl of live streams on the 28th of August on stocks. They're giving away 10 grand. Man, I know I'm tuning in. I know I'm going to be locked in. And if anything, I just want to be part of it. And we'll see how it goes, Oliver. I'm on the hook now. I open my big fat mouth, and we'll see where it goes. Brian wants to look at ATKR. So ATKR engages in the manufacture and sale of electrical, mechanical, safety, infrastructure product solutions in the United States. They do conduits, cables, installation accessories, and I have a sense of where this is going. And ATKR. Let's take a look at their 5-year. Whoa, look at that. They were like flying high, and then they just... So they were going quite well. And then more recently, they've been like getting hammered. So this is where I'm suspecting this is going to take us. This is going to take us to the data center. And these guys do products, technologies, and I'm gonna call them more like commoditized technologies for the data center. Let's take a closer look and go to their website and see what these guys are all about. So we're going to go to their website. So these guys do. So they do pressure pipe, conduit. So what industries are these guys supporting? So products and services. Okay, I understand that. Markets. So electrical power. Got it. That it? So data centers, right? So my spidey senses were tingling. So they support data centers and power companies. Now this whole AI, catalyst for AI is the data centers are going to get massive, and the power companies are going to have to be massive to provide the power that accelerated computing needs, which is a lot of power, by the way. And let's take a look and see where this company, I think, was run up, as you saw that chart. Because the expectation is, well, if you're going to need to make data centers bigger, you're going to need everything. You're going to need more buildings. You're going to need more conduit, more of their products to connect these data centers and make them work. Okay, that rationale I understand. So now that we look at this company that's supposed to benefit from the data center build out, we see that, well, how are you building data centers? They're supposed to be getting big, right? I'm going to make myself as big as I can. But we have negative growth rate. That's the opposite. What the heck's going on? What the heck is going on? If these guys are supposed to be building out data centers with their stuff, it's going in the opposite direction. And I think that's what the market's realizing is, whoa, time out. We've got what's supposed to be an expanding universe. Most definitely NVIDIA's seen that. NVIDIA's like, their numbers are incredible. But AdCore is not part of this data center build out, or they're just not. One of their competitors is probably taken over. Now, if we look at so obviously their revenue is going down. They're not that big annual wise. If you look at the company, they're smaller than they were 2 years ago, and they're a little bit bigger than they were 3 years ago. They are bigger than they were in 2019. I'm going to skip 2020 because that's the COVID year. That's the weird year. I'll give companies a pass if they didn't grow during COVID. We had a pandemic. All right, pass, no problem. But they're not, they're bigger than they were in 2019. I'll give them that much. Now, their growth rate most recently, that is an item of concern. If we look at cash flow, free cash flow for the trailing 12 months is $392 million. They have grown it nicely from 2019 to now. They are growing their cash flow. Okay, very good. So I'm going to call it $400 million of free cash flow for the trailing 12 months. They're not growing, but having said that, this company is fairly priced, rough cut. And if you think their business is going to grow, this might be an opportunity because the market is really punishing the stock. I mean, holy smokes, especially from here to here, it's 52%. And their revenue is dropping. They are getting, I would say that if there was an AI premium on this stock where people are saying, oh man, these guys are going to benefit from a data center build out, and they really, ran the stock up 161%. And now they're like, wait, they're not growing at all. So our whole thesis that they're benefiting from data center build out is out the door, out the window. It's down 50%. Well, at some point, like I showed, I could show just about any company out there. I'm going to go Uber. Uber was misunderstood. It was sold off. They're like, yeah, Uber is not worth what they are. They're a bad company. Let's sell them off by 64%. And investors like myself were like, yeah, thank you for the discount. Muchas gracias. And the stock took off. So is that stock, is the AdCore business going to do this? Maybe. If you have a sense of their business, I don't know enough about these guys. I'd have to kind of study them and track them. It doesn't knock my socks off enough for me to say, hey, I'd like to track this company, and at some point, maybe I'll invest. I think the excitement has kind of played out in the company, right? The whole going up and down. So right now, I would stay away. Just say, isn't that an interesting little case study there? So those are my comments on ATKR, Brian. What do you think of ATKR? Is it something that you think is worth taking a look at? Are you buying it? You selling it? You shorting it? Let me know. Would love to hear. All right. So I've been going for a little over an hour. It's Saturday. I've had a great day today. Had a nice morning, hung out with my wife. She's so awesome. Had a nice breakfast with her, hung out with her. we looked at some real estate. We're looking at investing. Saw one good property that I think might be worth looking into further. I'm also a real estate investor in Southern California, and this property looks good. Inventory in real estate is rising, by the way. Not sure if there's any real estate investors out there, but she's going to go hang out with one of her childhood friends. They're very good friends. So the afternoon, I am home alone. I get to stream. I get to watch Netflix, whatever I want to watch. You better believe I'm going to watch some sports. I've been catching up on the NASCAR Netflix series. I'm kind of hooked on that one, man. That's one of my vices is I'm not like a consistent Netflix viewer. I'm like, I think I've got to go to some type of treatment center. I will binge view. I'll like crank through a series, like 10 episodes in one sitting. And that's what I'm doing with this NASCAR, but it's pretty damn cool, man. Danny Hamill and Michael Jordan being a NASCAR owner now, and Bubba Wallace, and oh man, good stuff. And I'm not a NASCAR guy, but they're converting me into it. Same thing with the F1 series, the Drive to Survive. Oh man, my only problem is I crank through that stuff like on a sitting, and I got to space it out a little bit, but that's just the way I am. My passion is investing in stocks, investing in real estate, trying to make investments work, trying to use analysis, life experience, all my experiences, right? I'm 56. And, when I was 26, I had the enthusiasm, the energy, and the motivation and the passion, but I just didn't have the wisdom. Now I've got a little bit of wisdom. I was really good in college. I'm an accountant by education. I have an MBA. And when it comes to modeling and doing mathematics, for some reason, the universe said that I would be good at it. And I've been able to model some things as I look at investments. And I just love it, man. I love modeling things. And I've learned a lot from other streamers. I've got some friends online that, I think they're brilliant. We share ideas. And that's what's awesome about investing nowadays. It's the golden age of investing, man. 30 years ago, we didn't have live streams. We didn't have YouTube. We didn't have access to other like-minded investors. It was like a very, experience of solitude. You read books, you invest, you paid a lot of money for trades, and you kind of sat on investments for a while. Just accumulated, your savings. Another way of saying it is accumulate wealth. But over time, I kept, making bigger bets and, increasing my net worth. I think real estate really helped out. I bought real estate at the right time. If you follow back in the United States, in 2010 was a great time to buy. And that's when I bet big on real estate, and it really paid off. And ever since then, I've tried to bet right on certain movements within stocks. Sometimes I've been wrong, and the market charges me to teach me that lesson. Sometimes they charge me, hey, with some of my losers just for credibility. Intel recently, man, Intel freaking laid an egg after their earnings. I didn't have a big position, but it kicked my butt knowing that, I was really disappointed in the fact that they didn't pre-guide their earnings and say, hey, we're going to be terrible in our earnings. So I lost, I think I lost 40%, maybe 35% on Intel. And, I sold it off. It's just too much of a distraction. Get it off the portfolio. But in general, I think when it comes to investing in stocks, growing up, I played sports. I played football, baseball. I would have played basketball if I was good at it, but frankly, I wasn't good at it. I had really, really good friends that I played baseball with or football, and they crushed it when it came to basketball. All I could do was rebound and hustle, and that's not enough to be a good basketball player. But anyway, so I love American football, and for a while, I loved baseball, but I can't handle it anymore. It's too slow. Anyway, I've replaced everything like passionate about sports with stock investing because it's a lot funner. It's one thing to say, oh, my team is the Los Angeles Angels. And it's one thing to say, hey, my favorite ball player on the Angels is really doing well. But it's better to say, hey, man, I made a ton of money on Metastock and I bought it at the right times. And I'm going to keep making money on Metastock. It's a lot funner to have that type of story. All right. So I've got a question from US. Is it US Anchor, I guess. Where is a good idea to buy? Okay. So real estate. Let's talk about real estate. So real estate is, it's not like stocks. Real estate changes very slowly. It's almost like watching paint dry. Now, I'm going to try to get a graph, and I'm going to go California. The reason for it is real estate's always local. I can tell you what I see in Southern California, and it might be different in Atlanta, Georgia, and it might be different in Chicago. But let's just go. But there are some themes I think could be Could be things that we can hang our hat on. Look at that. Google's Gemini AI helping me out. Thank you, AI. So okay, so I'm just going to talk to it because I'm not getting a very good graph. I'm going to try one more time. And if they don't give it to me, I'm just going to abandon this. All right, I'm going to abandon it. So, all right, so real estate goes up and down very slowly. The last big correction we had in real estate was led off by the subprime mortgage meltdown, right? So this is The Big Short, the movie The Big Short. This is where, one second. So this is where the problem was that we had increasing interest rates. And what happened was that people that could barely qualify were qualifying into these assets, these big, real estate markets. And it would have been fine if real estate prices would have kept going up because they basically were buying these homes. They could barely qualify. These were adjustable rate loans. And when the prices of real estate started to go down, it caused a situation where they couldn't afford the home. They couldn't sell out of the home because the price of the home was worth less than the loan on the property. And the banks were stuck with a lot of properties. I bought one property from a bank and then decided to buy other properties directly from owners because it was such a pain in the neck to deal with banks. They took what should have taken 20 to 40 days and turned it into 4 months, 6 months. It was like, guys, you're eager to sell me a stupid property. Why do you take so long? But they're a bank. That's what they do. So back then in Southern California, which is a very good real estate market, and I say good because prices just don't go down in California. My mom bought a house when I was a youngster. I think I was 10, about 10, maybe 9. She bought it for $20,000 in Orange County, California. A beautiful place to live. 20 grand. It's like freaking ridiculous. Now the medium price is like $800 or $1 million. Medium. That means properties above, half of them are above, half of them are below. Bay Area is even nuttier. So in general, real estate goes up. Now real estate's been going freaking up since 2010, 2011. And it's been going up. During COVID, I thought prices were going to come down. Finally, they didn't. The scarcity of real estate caused a real appreciation cycle in real estate. So I believe prices in real estate are going to come down this year, next year, and the year after, because now we have more inventory. Now that we have more inventory, sellers are out there competing for eyeballs to come look at their properties. In fact, I have this page open. I was looking at properties. I look for both single family residences, but let me go to a property that I thought looked interesting. Now, this property, looking at properties that are multifamily, I think it's this one here. And we look at the pricing history. When you go on, this is realtor.com, and you can see the price history. No, that's tax history. Sorry. Price history. Okay. So in 2017, this property was sold for $995. Now, 7 years later, they're trying to sell it for $1.7 million. Okay. I think I've seen some properties where they've had multiple price reductions because the inventory of properties, and this is a multi-unit property. This is, I don't know how many units. Is it 3 or 4? It's probably a 4-unit property for $1.7 million. So I'm looking at real estate. I just started my, search because I know that prices were too high, but inventory has been building. So now I'm beginning to see, and I tend to be an investor that I want to be informed, and I might, kind of set my frame of reference over multiple months. So I think inventory is building in California, Southern California. Good deals are beginning to appear. And I don't know what your age is, US Anchor, but I mentor a couple of guys, and, one guy, he's the son of one of my good friends. I've been friends with him, for a long time. And then his boy, he's a great kid. He's not a kid anymore. He's 30, 32 years old. And he had the idea of buying a multi-unit, like a 3-unit, 4-unit, or a duplex, live in one, rent the other. Great idea. So if you're in that game, it's a great idea because you could actually buy into a property that produces income. You're going to see appreciation in your asset over time, and you can deduct everything. You can deduct everything against the rental unit. So you have a water heater go, deductible off your taxes. You have a new air conditioner it needs, deductible against your taxes. I mean, you can deduct so many things. And I'm not a tax advisor, no investing advice here. I'm just giving you observations. So that's a good idea there. Looks like you're 52 years old. You know, based on age, I'd be very careful. I'm looking at multi-unit, and the reason for it is I'd like to build up the number of units I have under rental, because I've learned to do that over time. You know, I guess we're up to 14 years of experience renting these houses and these units out to people. We kind of found our groove. This is what we like to do. And it's steady income. I'm 56. So I'm like, you know, if we add another 10 units, let's say I make $500 to $1,000 a piece. Let's call it $750 of profit per month each. That's $7,500 of income per month. Now, getting 10 additional units is a lot of money to put out there in capital. So I'm being very careful, and I'm not going to do that in one shot. It's be ridiculous. It'd be kind of nuts. So I'm just going to kind of go one property at a time. I might go with one property this year. Do your homework in your area. How I like to invest is I never invest in something I don't understand. I don't care if it's a stock. I don't care if it's Bitcoin. I tried to understand Bitcoin as much as I could, establish the frame of reference and why I invested in Bitcoin. And in real estate, I invest close to home. And the type of real estate that I invest in is residential, where I rent out the property. That's easy to get your head around. People need to live somewhere. They pay you a certain amount and you charge them rent. You can follow the numbers. The numbers are pretty simple compared to a stock. It's super simple. In fact, I put together a model, and I'm going to do a live. It's actually more of a community call tomorrow. So I was prepping for that. Some of the investors that I hang out with, they really wanted me to do analysis on properties. So I put together a model, and I'm showing the property that is probably the top of the stack of what I've seen. Short term, over the next 5 years, if I invested in it, I'm going to have a negative internal rate of return. But over 10 years, it would have a positive rate of return of 10% and then 11% over time. That's not very good in real estate. If I showed you the properties that I invested in 2010, they have a rate of return of like 25, 30%, which is phenomenal, beating the stock market. But right now it's not as good. So I wanted to kind of show the numbers there. I go local, kind of look at the communities that I know that I think I can manage. And then I do my homework. I look at properties. You got to look at least 10 properties, and look at them means look at them on paper like I'm doing here. Go walk the properties, understand that market. What can you rent them for? What can you rent those units for? Really put yourself in. I don't know if you're a real estate investor or not, but understand that like once you own real estate, you need to make decisions like, am I going to do the management of the property? Am I going to leave it up to somebody else? I'm more of a hands-on kind of guy for a couple of reasons. One, when I bought properties, that was a lot of money. I worked freaking hard for that money, right? So I'm not going to leave it up to somebody else to manage that really expensive asset. And I like having a direct relationship with the tenants, and I have a good relationship with the tenants. I've had a couple bad apples, the situation just didn't work, but that's okay. You know, can't expect every relationship to be perfect. But I would say all our tenants right now, I think they like having us as their landlord. We like having them as our tenant. We have a nice, very respectable, positive relationship. We have one tenant, he's moving out January 25. We've been super cool to him. He's been super cool to us. And the relationship's been positive both sides. So you need to decide, you're going to manage direct, you're going to hire a property manager. I don't like property managers. I think they charge a fair amount and they remove you from the equation. In Southern California, the real estate's so freaking expensive. I don't want somebody else. I mean, I'm not going to let somebody else do the calculation on Meta stock. It's not like, hey, I'm just going to believe everything that, and I'm just using this as an example. Jim Cramer says Meta's good, so I'm going to buy Meta stock. No, I'm going to go through their financials. I'm going to look at their cash flow. I'm going to look at where's Meta going? Why do I think they're going to be more valuable? Then I make the decision. So real estate should be the same thing. Why do I want to buy in that market? Once I own that asset, why am I going to leave it up to somebody else to tell me what the condition of the property is? And when my tenants call and say, hey, the stove's not working right, I do the visit because I want to look at the property and see what condition they're holding my asset in. Are they taking care of it? And the tenants know that the owner is going to come see the property if there's ever an issue with the property. So the relationship's really good. I use those opportunities to really look at the asset and make sure everything's cool with it. And then if it's something over my head, like if it's something simple, like, hey, a fuse has to be flipped over, I call professional tradesmen. That I got a guy for air conditioning, I got a guy for electrical, I got a guy for plumbing, I got a guy for this, and then a guy for that. And no issue has ever come up that's kind of knocked me over. I've had situations where I've had to, fork out $5-7 grand to do some type of, I'm going to call it infrastructure improvement, like new air conditioner and stuff. But it's always, it's been a really good thing. These properties have appreciated big time. Probably the one story I would give you out there is I bought two properties in an area near where I live in Southern California, but referred to as Big Bear Lake. And we bought these properties. They basically we did Airbnbs for two properties, and they would positive cash flow, 65 grand a year. Beautiful. Out of two properties. And once we look at that was net profit. The properties themselves, one of the two properties, we bought it for 325. So we put down 30% on that occasion. It was like 75 grand or so. We sold that property for 980 grand, roughly 10 years later. So we took 75 grand and turned it into close to call it a $600,000 gain. So it was a really good investment. And that was really fun because we got involved with Airbnb. We got involved with short-term rentals, understood that market, and we're really hands-on. But then we partnered with really good people that would clean the property, maintain the property. We became really good friends with that, small business, and we helped them grow their business. And that was a really good success story. Now, that was a situation of 2010, 2011, 2012. Short-term rentals have gotten a lot harder, and short-term rentals have gotten riskier. But I would say at 52, study your local market, understand where your lane is going to be to where you can operate best, where you have the best knowledge, where you're comfortable from a capital outlay, and do your homework. Visit more than 10 properties. You can't do enough homework, because once you buy a real estate asset, it's not like buying meta stock that you can change your mind tomorrow and sell your position. It's very hard to get out of real estate, especially in a declining market. It's very painful. If people buy an asset and it starts going down in value in real estate and you're about to lose 50 grand, I know that would be very painful for most people. So do your homework right now. I would say you got to double the homework. You got to double the analysis. You got to make sure you're buying a really good deal. And this is a situation where you have to see yourself owning that asset for more than 10 years. It's real estate right now is not a short-term deal. Home flippers, that's a different business that I'm not in. I don't want to say that it's a bad business. If it works for somebody, great, go make money. It's not a business that I want to be in. If I'm going to make a lot of money this year, 2024, but the money I made it by making decisions a year ago, 2 years ago, 3 years ago, 4 years ago, 5 years ago, and it just compounds. So it's almost like I make money while I sleep. And that's how I want to keep it. I want to make the right decisions today. They're going to benefit me in 2025, 2026, 2027. And then I could kind of feel like, hey, I am going to be surprised. I'm going to lose some money here or there. But in general, most of my investments are going to do well over time. So, real estate, I think, is going to be a part of every investor's portfolio, because owning your own house, especially, you get to lock in your cost of living, right? The house that I'm in, we bought it in 1999. So I locked in my cost of living pretty much to 1999. And that's really kept our family's cost of living fairly stable. It's been a very well appreciating asset. So I imagine most investors that make some money are going to buy their own property just so they can lock in that, cost of living. If anything, it's just a good investment over time. You got to diversify. You can't just own NVIDIA stock, even though if you only owned NVIDIA stock over the last 2 years, who am I to tell you that was a bad thing? You probably made $1 billion of value. But all kidding aside, diversification is one of the disciplines of solid investing, so that you don't put all your eggs in one basket. You kind of diversify away from certain asset classes. Stocks being super interesting, move very quickly. Bonds, real estate, crypto, and maybe there's some other assets too that you are interested in. So good question on real estate. I have, if you visit my community page, I host a call, like it's a Google Meets call, and we talk. Imagine that. And tomorrow's one of the topics is going to be real estate, because I've had 2 requests to talk about real estate. And I know that we are talking about stocks in this channel. We're talking about stocks primarily in this live stream. But again, I got to listen to people. And if they said, hey, let's talk about real estate, I'm going to talk about real estate. All right. So I've got another comment coming in. Let me get my computer to where I want it to be. Your thoughts on buying option income like ETF, YSY, yields are great. Prices may decline very fast. All right, let's take a look. And I think you're talking about these ETFs that use leverage to go deeper into a position, right? Okay, so So let me get my head around what is this, and then we'll talk about it. So this is writing call options on NVIDIA. Okay. So one of the things that, I'll put it out there that's really important to me is when I invest, I try to keep it as simple as possible. As simple, the simpler, the better. I thought Uber stock was discounted. I thought Uber was going to grow. I thought Uber's addressable market is expanding. And I believe Uber is number one in that category. That's a very rational, simple mindset. And I looked at their fundamentals, put them into my free cash flow discount schedule that I showed, earnings per share. Simple, simple, simple. As simple as possible. As soon as you say options, simple left the building. So when you're using a sophisticated selling, writing call options ETF, to understand this would take me so much time and energy. It'd be hard. So that would be a first kind of pump the brakes. I may not be interested. I'm probably not going to be interested, but let's keep looking. I want to answer your question and kind of tell you, hey, this looks interesting. Or you know what? I would never touch this. This would be something I'd never do. And here's why. Or I might be like, hey, this might be interesting. Worth taking a look. I mean, BTBT, a live stream attendee brought that up. And I mean, that's pretty damn risky. And the more I dug into it, I'm like, hey, this is a pretty good idea. I'm buying. All right, let's take a look. Yield Max, NVIDIA. They don't invest directly into NVIDIA. Investing in the fund involves a high degree of risk. Thank you for the transparency. Single issuer risk. Now I'm going to read silently. Sorry, guys. So they have a yield of 4.3 over the last 30 days. NVIDIA stock, I mean, it's been kind of a rough 30 days, so to speak. It went down, then it went up really fast. But I think overall it's up over the last 30 days. Distribution rate, 60%. Distribution per share. So they're writing calls. So if you're writing calls and saying NVIDIA stock is going to go up, I'm going to buy some calls, and then the stock goes up, and you made money because you're like, hey, I'm going to write a call with the 5% above the current stock price. It goes up 10%. Hey, I made 5%. Okay, that makes sense. I think that if you're looking for income, talking about income and talking about NVIDIA and talking about options is like a very rare conversation piece. When we talk about income, it tends to be low risk, dividend stocks. They've been around forever. These are stocks that, your mom or dad bought and you are familiar with. They tend to be with very stable kind of industries. Or you can buy bonds. I mean, you can buy a long-term bond and make 5%, if not 5.5%, 6%. That's low risk. So yielding 4% in 30 days, that means that you could yield upwards of 50% a year. That's a very attractive return, but it's really high risk. I would say if you're buying, I don't understand how if they're buying call options, if they're selling them, if they think they have some type of advantage on the market. It wouldn't be the right investment for me, but at some point, this isn't going to work. If NVIDIA keeps going up, wonderful. But I think I've shared plenty of comments on NVIDIA and how I think it's not going to continue to go up. It would kind of break, if anything, this investor's whole thought process, and as well as many others. I'm not the only one. Other like super investors on YouTube and so forth. One guy that I really like is Josh Brown. He has a direct channel. I forgot what it was called, but he was an NVIDIA stockholder. He's gotten out of NVIDIA. And if you listen to his comments, I mean, he's not coming out saying, oh, NVIDIA is going to crash and burn, but he's basically said, NVIDIA is in no man's land. We're at a space where who knows what's going to happen because NVIDIA has completely detached itself from fundamentals. It's up there in the ether. It's just floating around. It's just based on how much retail investors believe in it. And really the money, the big money, if big money gets out of it, and some big money has gotten out of it, we'll see that stock slam down. This particular ETF, I would not invest in it because it's just, I don't understand it. And if I want like income, I get it elsewhere. I get it in bonds. That's my favorite income producing asset. I'd rather really know that, hey, I'm going to buy something that I'm getting into. I know how to get out of it. And this one here, I just don't know enough about. I wouldn't probably be interested just on high level, looking at it. It doesn't fit me. Okay. So And then TSLY. Let's take a look at that. So option income. And I guess the question I would have, if you and I were just like hanging out talking, if these ETFs that involved options are interesting, why don't you learn to trade options? Oftentimes, you know, like 20 years ago, I was mostly into what we call the mutual funds, but now ETFs, the term. I was mostly into ETFs, and part of it was professionally, I was super busy. My kids were little. I wanted to spend time with them. So my amount of time that I can invest in researching companies and so forth, and frankly, my knowledge wasn't there. So I bought ETFs. Now that I have, I think, the ability to analyze companies and so forth, I'm always for being in the individual investment and then buying investments that fit my portfolio, tailored around me and my family and my family's needs. Then I can buy individual bonds that fit a maturity, you know, schedule that I want based on the yield that I want. I buy stocks that fit a particular profile based on what I believe I'm good at investing in. And then I manage to, you know, those investments with that insight over years of investing in a particular stock. Options. I invest in options. I sell and buy options. I sell and buy puts. Now, again, specific call options on a specific stock. Now, if I have an advantage on a stock, a knowledge advantage, I know that stock really well, and I think I'm buying a good option, great. When I go into an ETF, I get the control and the insight and frankly, the decision is taken away from me. So I don't like ETFs for that reason at 56 years old, where I'm at. I'm managing a fund of resources and wealth that I've built for my family. I want to keep growing it. I think I've gotten to a level of knowledge and ability where I could accelerate the growth of my family's net worth by making really good decisions that are specific to a reason and an outcome in my portfolio. So I stay away from ETFs. You know, I have a couple of them, but they're mainly with my wife's old 401k. You know, her 401k doesn't allow the type of investing that I do, which is very individual stock specific, individual bonds specific. Even with real estate, right? I have one REIT, real estate investment trust, and it's with a company that does healthcare facilities for people that are fairly old that need to live somewhere that need healthcare. And it's a really good REIT, CTRE. But that's the only REIT that I own. Everything else is direct real estate assets. So when you go with direct, you know, buying call options, buying puts or selling put options or selling call options, why are you doing it? Is it because, hey, I want to produce some income, or I believe this company is going to be worth 3 times as much in the future? I want some protection, or maybe I want to control 10,000 shares. Okay. If there's a very good thesis, if you have a very good, like, hey, that's what I truly believe in. I believe in my research, and, you know, you've done this over and over again. Start small, bet small when you're first learning, then maybe go to a direct, you know, option is how I would think, but that's me. That's the advice I would give myself. I don't know your situation. And I hope that my comments, you know, are interesting to you. I think if you watch me more, you'll understand my frame of reference. Again, 20 years ago, I was mostly an ETF investor. It was for other reasons that I didn't have the time to research companies. I now have more time. You know, my kids are now like 20 and 24, and they're pretty much young men doing their thing. Both are in college. One's studying a PhD. The other one's starting his junior year. He's economics, mathematics major. So they're doing their thing, and I've got, you know, more time, and I can really sink my teeth into analyzing companies, which I love to do. Sink my teeth into hanging out with other investors like you guys. So those are my comments on ETFs and my comments on these investments that are looking to buy options. I've also heard about some NVIDIA ETFs that they're basically like your triple exposure to NVIDIA stock. So if it goes up, it's like 3 times the upside. If it goes down, 3 times the downside. So talk about risk, man. Whew. That's called either get rich fast or get poor fast. Yes, it's going to be one or the other. And, you know, I'd rather be like, I think there's a wise saying out there that, you know, you only have to get wealthy once. Why risk it all when you've got it all, you know? So I think a lot of, you know, once you get there and you got a net worth that you're like, great, this is what my family needs. Why would you put it at risk? Instead, you know, grow in a methodical way where you feel like you're controlling risk. You're still, you know, having a great return on investment, but you're not exposing yourself to too much risk. My goal is to double my stock portfolio every 5 years. That's a very good rate of return. That's my goal. That's the road I'm on. I have other portfolios, like my portfolio that is meant to take care of my living expenses for the next 5 years It's low risk. It provides income. It's all bonds. Now that has the outcome I have there is I take my living expenses for the next 5 years and take them off the table. That's completely off the table. That way, if my stock portfolio tanks, like it tanked in 2022, along with everybody else, or the subprime market meltdown, I'm not forced to sell one share. I can manage through that downside. I can manage through that down market, make some good moves. Hell, I put more money in those occasions, which was a really good idea, and then invest. Same thing with real estate. When the market just crashed, it was like, great time to buy. Boom. So that's why I have this bond portfolio. It's called a bond ladder. Look at my channel. I've got a bond ladder video. I just recorded that video like 7 days ago. And I speak to how, I take living expenses off the table for the next 5 years. That way it gives me enough time to, whatever comes up, I can figure it out in 5 years. I've been around for 56 years. Maybe when I was 16, I couldn't figure it out. Maybe when I was 26, I couldn't figure everything out. But man, financially, hell, you give me 5 years, I will figure it out. Even though you give me some really tough headwinds, I will figure it out. All right. So it's been a good live stream on my side, guys. I know I've got 24 viewers. I thank you so much for viewing. And I will be around more often on stocks. And this is my weekend stream. What I was thinking of doing during the weekdays was opening the market on stocks every day. It's going to be probably from what I'll call 6 a.m. Pacific in California, maybe stream for about an hour, kind of get our heads, into the game. I usually don't trade the first half hour of the trading day. I just don't touch the volatility that happens in the first half hour. I'm a long-term kind of investor, but, I'm active, which means, I might hold a stock. Like I think I mentioned, I shorted a few stocks. So after 10 days, I got out of CrowdStrike after a really good return. That's the exception, but that's something that I saw and I acted on. But I wanted to do live streams during the weekdays to open the market. So if you're interested in that, tune in. And I'm going to do it on stocks this coming week. I'm going to do it each day, and maybe do another one maybe in the afternoon, and see how that goes. I welcome feedback from anybody. If you think something maybe needed some polishing and could be improved, please let me know. My intent is to be out there and help a bunch of investors and help with content, maybe providing one more perspective. If you're not agreeing with me, that's great, because we're not supposed to agree. Nobody's wrong at this moment. Time will tell who's right or wrong. But for now, I want to listen to your point of view. I want to listen to why you think a particular stock's going to go up or down, because I'll probably learn something in that conversation, or it'll reinforce maybe something that I really do believe in. So keep that in mind. And I think that's all I got to say on this live stream, everybody. I really appreciate your attention. Big thanks to the Sonx team. I'm having a lot of fun. I'm having a lot of fun on the streams that they produce, by the way, and usually get a lot of laughs from here or there. But overall, I'm getting a lot of value in kind of just hearing from more investors and hearing their points of view on the market and investing. So with that, everybody, enjoy your Saturday. And everybody, let's keep our fingers crossed that next week is going to be a positive week. Again, I know everybody's going to tune in to stocks on NVIDIA earnings day. It's probably going to break the internet. We'll see. I'm going to tune in. I'm going to be all ears. I'm going to be all eyeballs. We'll see what happens, and we'll go from there. Everybody, take care. We'll see ya.